Welcome to our in-depth exploration of the most significant stock market crashes in history and the remarkable stories of recovery that followed. The stock market, a vibrant and continuously evolving hub of financial activity, is akin to a complex, carefully balanced ecosystem. It reflects a diverse range of factors such as economic health, individual and institutional investor behavior, political stability, and even global occurrences like wars or pandemics. Despite its complexities, the stock market is not immune to dramatic downturns, each with its unique blend of causes and effects. These crashes are usually the result of an intricate interplay of several factors. Over time, these factors have included extensive speculation, margin trading, inadequate financial regulation, and often panic selling. Let's journey together into the heart of some of these tumultuous events. We'll be examining various crashes, their causes, their profound impacts, and the often complex, lengthy path to recovery. One such event was the 1929 crash, which signaled the beginning of the infamous Great Depression. The crash was sparked by rampant speculation, with investors heavily to buy more stocks, a practice known as margin buying. This speculative bubble eventually burst, leading to a catastrophic fall in stock prices. The recovery from this crash was a slow and painstaking process, extending over a decade. The primary factors that aided this recovery were the introduction of President Roosevelt's New Deal policies, which were designed to stimulate economic growth and job creation. Alongside this, the onset of World War II drastically boosted industrial production, leading to significant economic stimulation. The 1929 crash, marking the onset of the Great Depression, was fueled by excessive speculation and margin buying. The recovery was slow, spanning a decade, and was aided by New Deal policies and World War II's economic stimulation. Black Monday of 1987 was the consequence of program trading, overvaluation, and market psychology. It was a day when the world watched in disbelief as the seemingly invincible Wall Street collapsed. Even today, the term Black Monday sends a shiver down the spine of those who remember it. The day started just like any other trading day. However, as the morning proceeded, traders noticed an unusual downward trend. Stocks were dropping at an alarming rate, causing panic among the traders. They were dealing with program trading, a relatively new concept at that time. Designed to execute large orders efficiently, it became the harbinger of the crash, acting as a catalyst in the collapse. The market was also overvalued, a dangerous condition where the prices of stocks exceeded their intrinsic values. Investors were buying on speculation, banking on future profits rather than current performance. This created a bubble, a fragile situation that could burst at any moment. Lastly, market psychology played a significant role. Fear and panic spread like wildfire among investors. This fear-induced selling resulted in plummeted prices and a free-fall market, which came to be known as Black Monday. However, the aftermath of Black Monday saw the introduction of circuit breakers and computerized trading systems. Circuit breakers were designed to prevent panic selling by halting trading if a market fell too rapidly. Computerized trading systems, on the other hand, were designed to manage and process large amounts of data, ensuring a more efficient market. These measures helped stabilize markets and expedite recovery from such financial disasters. Triggered by the collapse of the Thai baht, the Asian financial crisis of 1997 was a catastrophe that sent shockwaves through the global economy. This crisis, also known as the Asian contagion, was a seismic event that originated in Thailand but quickly spread to neighboring economies, causing economic downturns and social upheavals. The root cause of the crisis was a heady mix of heavy foreign debt and speculative investments. Many Asian countries were borrowing heavily from abroad, building up unsustainable levels of foreign debt. These debts were primarily in the form of short-term loans, which left these nations vulnerable to shifts in investor sentiments. In the mid-1990s, many Asian economies were seen as tigers, their rapid growth fueled by substantial foreign investments. However, beneath this facade of prosperity, many of these nations were teetering on the brink of financial ruin. What followed after the Thai baht collapse was akin to a financial tsunami. Stock markets plummeted, currencies devalued, and businesses folded. The crisis laid bare the inherent weaknesses in the Asian economies: an over-reliance on foreign capital, the lack of transparency in financial dealings, and the absence of effective financial regulation. The recovery from this crisis was a long and painful process. It involved stringent measures imposed by the International Monetary Fund, IMF, through bailouts, coupled with a series of structural reforms. These included tightening of fiscal policies, strengthening of financial systems, and enhancing corporate governance. This stringent reform process, though tough and demanding, led to the emergence of more resilient Asian economies, equipped to handle future financial shocks. The lessons learned from the 1997 crisis continue to shape the economic strategies of these nations, making them more robust and resilient. The burst of the dot-com bubble in 2000 was a seismic event, a financial tremor that resonated globally. It was a time when the world of finance was caught up in a whirlwind of inconceivable speculation. This was especially true for internet-related companies that were at the epicenter of this massive financial upheaval. This event was not just a mere hiccup in the economic landscape, but a thunderous reality check that shook the very foundation of the corporate world. It was a rude awakening for many who had put their faith and their fortunes in the promise of the digital revolution. Their dreams shattered like the monitors of the computers they had invested in. The once bright and vibrant digital landscape was now a barren wasteland, littered with the remnants of failed startups and shattered dreams. Yet, like any significant historical event, the dot-com crash of 2000 was not without its silver lining. The market, like a phoenix rising from the ashes, began to correct itself over the ensuing 2 years. The correction was not immediate, nor was it without pain, but it was a necessary part of the healing process. A process that was essential in purging the system of the excesses that had led to the bubble in the first place. And from this process, a new dawn emerged. A dawn that heralded a more sustainable and realistic growth pattern for the tech sector. This growth was not fueled by irrational exuberance, but by sound business principles and innovative ideas. This was not the Wild West of the late 90s, but a mature and steady-paced growth climate. The market corrected itself over the next 2 years, paving the way for more sustainable growth in the tech sector. The 2008 crisis, sparked by the subprime mortgage meltdown and Lehman Brothers collapse, led to a global recession. This was a period that saw businesses crumble, homes foreclosed, and millions plunged into unemployment. The repercussions extended beyond the United States, as global markets and economies were deeply affected. Wall Street was sent into turmoil, and it appeared that the world was on the brink of a financial abyss. The subprime mortgage crisis originated in the US, where banks and financial institutions were enticed by the lucrative prospects of providing high-risk loans to homebuyers with poor credit. When these homebuyers defaulted their loans, it triggered a chain reaction, leading to a nationwide housing market crash. Lehman Brothers, a renowned global financial services firm, was unable to withstand the blow and filed for bankruptcy. This was the largest bankruptcy filing in the history of the United States and marked a turning point in the crisis. The collapse of Lehman Brothers sent shockwaves through the global financial system, and the ripple effect was felt across the world. Recovery from this catastrophic episode was slow and painful. It was facilitated by extensive government interventions. These included bailout packages for struggling banks and businesses, and quantitative easing to stimulate economic growth. These policies, which were both lauded and criticized, played a critical role in stabilizing the economy during this tumultuous period. As discussed in Governance, Regulation, and Financial Market Instability, the implications for policy, these interventions were deemed necessary by governments across the globe to prevent a complete financial meltdown. Despite the controversy surrounding such measures, they were instrumental in the recovery process following the crisis. The COVID-19 pandemic caused a rapid market crash in 2020 due to lockdowns and economic uncertainty. However, aggressive fiscal and monetary policies led to a swift recovery, as detailed in Inside the Mind of a Stock Market Crash. Each crash has unique recovery patterns. For instance, the 1987 crash, 2008 financial crisis, and COVID-19 pandemic show that recovery often involves a mix of policy intervention and market self-correction, as analyzed in Statistical Properties of the Aftershocks of Stock Market Crashes Revisited. These crashes teach us about the resilience of markets and the importance of regulatory oversight, investor education, and diversified portfolios in mitigating risks. History's financial tremors remind us of the cyclical nature of markets. Understanding these cycles helps investors navigate uncertainties and